Okay, geez, I hope everybody's doing great today. So today we'll just talk about something so important for risk management that if you don't know it, you'll just end up blowing up your accounts. So basically, it's the art, the way of where to put your stop loss and where to put your take profit. Now, of course, people might tell you, oh, you need at least to have 1 to 3 risk to reward, or 1 to 2 risk to reward, and people will be a bit skeptical to put 1 to 1 risk to reward, right? Because in mathematics, I mean in basic mathematics, you should risk less than you earn. So for example, if you have a 1 to 3 risk to reward, if you have 3 losses in a row, then you'll basically have one win and you'll make up for all your losses, right? However, people don't understand that if you take a trade, you shouldn't try to make this rule fit the opportunity that you're looking at, because you're basically trying to fit a certain rule to a market that doesn't care about your rules. These are your own rules. So you should adapt to the market. You shouldn't try to make the market adapt to your rules, right? So let's say I want to take an opportunity of buy in this Euro USD, right? Where do you think, if I buy at this current level, where do you think I should put my my stop loss and my take profit? It's a very easy answer. So if I buy here, for example, I will put my stop loss below these lows. Why? Because if I have an opportunity of a buy, I will only put my stop loss here, because if the price reaches this level, of course, this will invalidate a buy opportunity. So the price should not reach this level. It should not reach this level. You should put your stop loss not where you want to put your stop loss, but at the level the price should not reach. And if it reaches that level, it would basically invalidate it, right? Everything seems clear, right? Then you should put your take profit. You can put your take profit at this high, for example, because the price has a high chance to bounce from this particular high as it's breaching these levels, right? And this would be basically your first take profit. Now, if I zoom out, if I can zoom out here, there is another high here. So this is also a level where the price can bounce back from. So if I put here my stop loss, I put here my first take profit, that's going to be a bit less than a 1 risk to reward, than a 1 to 1 risk to reward. If I put it here, that's going to be around 1.5 risk to reward. And if you want to reach a 1 to 3 risk to reward, is basically going to be is going to have to reach these levels here, right? This range of price. So the stop loss needs to be where the stop loss needs to be. You shouldn't try to put it here, for example, because that's too risky. It can come here and bounce back again and go back as a buy. You shouldn't try to have a tight stop loss if it breaches the rule that the stop loss needs to be where the stop loss needs to be. Now, there is some people using a trailing tight stop loss. So basically, you would put your trade, and as the price goes in your favor, the stop loss would trail with the price, follow the price, and be tied to the price. So as you're in profit, if the price reverses, you're basically out of the trade with profit, right? And if the price goes with you, obviously you should scale up, scale in, okay? However, this is a very good example that no matter what type of example I use, for example, if I use this sell opportunity right here, if I sell at these levels, I can either put my stop loss tight to these highs here, or I can put my stop loss a bit more wide to these highs there and try to reach these levels first as a first take profit and then a bit lower as a second take profit, right? So the stop loss needs to be where the stop loss needs to be. I said it, I'll say it again. If I want to be more secure, I want to be more confident in my trade, I will put my stop loss at this high, because if after reaching a high here and not being able to reach back to these highs, I feel safer putting a stop loss here, because no matter what the price will do, if the price breaches these levels, I basically took a wrong direction, right? And this would invalidate my trade. However, sometimes people put a stop loss too tight and then they get taken out and then the price goes in their favor. The reason is that they put their stop loss in a position or in a price where if the price reaches this level, it doesn't invalidate the trade yet. However, if you put your stop loss in a level where, okay, if the price reaches there, it completely invalidates the trade, then this is a right way of putting a stop loss. So I will put a stop loss here where the price is not supposed to reach, because it doesn't make sense for the price to reach there. Even if you would feel that, okay, it's a huge stop loss, well, guess what? The stop loss needs to be where the stop loss needs to be. And then I would take my first profit here, so I would be careful in these pullbacks. And then as I see this, I would basically scale up, scale in. I would put more cells so I can have an increased profits, basically. So I think that makes sense, right? I hope that makes sense for everyone. Everyone understands exactly what I'm talking about and where I'm coming from. So I used to put my stop loss very, very tight. For example, I would basically take a sell here and put my stop loss at these levels, but this is too tight. These levels are okay, but again, it wouldn't completely invalidate the sell. But if you put it here and the price reaches there, that was basically a very, very bad trade, because the trade got completely invalidated. So it was a wrong direction. But however, here you might see, for example, the price slipping up, and if you put your stop loss here, you could be taken out. So the price could reach your stop loss and then go in your favor, and you don't want that. You want to have a safe trade and then let it run, right? So I think these are good examples, and I can go on and on and on in any pairs, in any market, in any type of financial product, in any asset. Look, it's the same rule everywhere. The stop loss needs to be where the stop loss needs to be, and you need to be able to read, with all we talked about and all the material I gave you. You need to be able to read where the price is going, where the price is not supposed to go, right? And then you can basically adjust your entry, and I'm going to talk about this as well. You need to know exactly where to enter. So basically, if I take the same example here and I get a sell, I want to have a good price to sell from. Let's say I see this push to the downside and I see this coming back up as a small pullback. I want to be able to sell at the highest price possible. And how do I do that? So if I read the market carefully and I see this first push to the downside, and this choppy move to the upside, and this aggressive move back to the downside, of course, I would ask myself a question: why didn't just completely continue going down? So I would see this move, and I would see this move going down. I don't want, for example, to take a trade around here, because that's a very low price, and traders would rather die than chase the price. So I would try to put, for example, a limit here. Or if I'm early on this move, I would put a limit, a buy limit or a buy stop around here. So when the price is reached, then the sell is automatically taken, right? Now that's very tricky because you need to exactly know what you're doing and the exact point you want to enter the trade. So what I do for the sake of safety, I put alarms at certain levels I want to enter the market. I know exactly where my stop loss will be and where my take profit will be, but I want the best possible price. So if I sell, I want the highest price from where I can sell without that trade being invalidated. That's very important. And if I buy, I want to have the lowest price possible so I can have the full profit of the bullish move, right? So you want to be able to do that. And we talked about all of this, and we talked about the exact entry and the exact exit as well in previous videos. You want to check that if you didn't check it yet. So this whole bootcamp will allow you to first of all recognize, be able to read the market, be able to recognize a good edge, a good setup, and be able to take the trade and manage your trade the best way possible. So we'll jump in the next video and we'll talk about more things. We still have 10 days to go, and hopefully we'll be able to cover everything you need to be a good trader. See you then.